Hello, I want to thank everyone for coming to our webinar today on how tax planning changes through the 4 stages of retirement. And I want to start out with a tax brain teaser. So Bill is retired and he has taxable income of $42,275 for the year, 22% bracket. So you can see that over here. It includes $38,000 in IRA income plus $25,000 in Social Security benefits. So he taps his IRA for an extra $1,000 to go to a concert and take a road trip. And how much tax does he owe on the extra $1,000? So it seemed like he just, since he's in that 22% bracket, it looks like he would probably just owe $220 on that withdrawal. But what ends up happening is he hits a threshold and he actually ends up paying $407 in tax on that income. So we're going to talk about what this means and why this happened a little bit later in the presentation. But right now, what's really important is that you use professionals. So CPAs can be amazing with helping with some of these complex issues. You may or may not need that based on your situation, but I'm going to be talking a lot about taxes today, and really you want to consult a professional on the tax side to make your real decisions. Okay, so different things that we're going to take a look at: traditional IRAs, 401ks, any corporate retirement plan or school retirement plan is going to be tax deferred income when you start taking money out of that plan. Okay, so you don't pay tax on the way in, you're going to pay tax on the way out. Roth IRAs are different. Okay, and Roth 401k, 403b, you're putting in money after tax. So as long as you have the account in place for 5 years and meet all the criteria, you will be able to pull that money out plus any earnings without paying tax on it. And then also, check on your state taxes. A lot of folks that are on this webinar, are in New Jersey. So the state taxes can be 6% or greater, but we need to take a look at what those are as well and how that impacts your withdrawals at retirement. So one thing is that, most of the time in the plan, you're really accumulating money. So it's different. You kind of hit those tax brackets, you have certain deductions. But now, as we're moving more into retirement, your mortgage might be paid off. You're not making 401k contributions and things like that. So your taxable income maybe could be a little bit higher. You're just not going to have as many write-offs. And now we need to worry about Social Security requirement, minimum distributions, and how all this fits together to make sure that you're set for retirement. So a lot of times what happens is that people actually pay more taxes in retirement than they've expected, because it is confusing and things are treated differently. And we'll talk a little bit about that depending on where you take the money from, and there could be hidden taxes and penalties. Okay, so what we want to do is really take a look at these different things, and I'll just show you where some of the pitfalls are, and then you can work with a tax professional to give you some help in really figuring this out, to hone in on it. So there's really, what we're going to talk about today are 4 stages of retirement. So pre-retirement, so we're kind of getting ready to retire, ages 50 to 60. You're working, you're saving, maybe putting some kids through college, and you're starting to really think about what retirement's going to look like. Early retirement, age 60 to 70, you're probably still working, might be working part-time, may have kind of slowed down a bit, but still kind of moving. Maybe you are traveling more and getting used to being retired. And then middle retirement, starting to kind of settle down a little bit more, age 70 to 80. This is where my mom actually fits in here. She's still playing golf a lot, but not traveling as much. And then late retirement is maybe some folks, some clients I know are traveling like crazy and very, going strong in their 80s. Others are, there could be medical issues or things like that. Okay, so there's different stages that we go through, in retirement. Some things to think about are inflation, of course, and lately inflation has been really high. You see it at the gas pump, you see it in the stores. Hopefully, I don't think it's going to end soon, but hopefully it will not last, more than a year or two more. But something to consider. Okay, the rise in the price of goods has a huge impact on spending. Longevity, no one knows how long they're going to live, but we want to make sure that we are prepared when I do a plan, we usually prepare to at least age 90. And if clients have family members, their parents that live longer than that, then we put that illustration out a bit. Also want to look at expenses in retirement and healthcare, which can, be one of the biggest expenses as well. So what's the first thing to understand about retirement and taxes? So we just want to take a look at your after-tax retirement savings picture, okay, and see what it looks like. So this is a little bit of a different way to look at your assets. So you're married, filing jointly, depending on how much income you have, how much tax you're going to pay on this money. $500,000 could be $325,000 or $315,000, depending on what your tax issues are. Okay, so you'll see this illustration is 6% rate of return, and this is your after-tax distributions from a regular IRA, traditional, or a traditional 401k. Okay, so if you're not paying taxes at all, over time, you could get $930,000-$40,000 out of that investment, okay, at a 6% rate of return. You can see the higher the tax rate is, so 33% tax rate, that $500,000 is only producing, $620,000 of income. Okay, so this is important to take a look at, and it's really great to do retirement illustrations. The sooner that you do those, usually the better, because then you might have time to kind of make up some differences and things like that. But important to do retirement illustrations. So we say, oh, but we'll have Social Security and Medicare to help pay for things. Well, that's true, but they also have tax traps. Okay, so we need to make sure that we're not hitting these traps like we talked about initially. Okay, so Social Security and taxes. This Bill, remember at the beginning, he went on the concert trip. So before the concert trip, his income was $38,000, and after his IRA, he had to take, it was $39,000. Okay, so Social Security benefits, adjusted gross income, taxable income, and income tax. So you'll see $1,000 more. However, the adjusted gross income went up considerably. Okay, because what happens is that for he hit a threshold, and when you go over that threshold, you pay 85 cents you pay tax on your Social Security income. Okay, so each of these thresholds is going to be a little bit different, but talk to your accountant about that and what makes that income taxable. Okay, so he's still semi-working, and so if you make a certain amount of money, your Social Security income does get taxed. Okay, so his income tax again went up by $407 because he got hit with 85 cents on the extra $1,000 he took out for Social Security taxes. Okay, so there's different retirement approaches. Some people say, I'm done, and they retire completely. Some semi-retire with fewer hours, so maybe only working a couple days a week. I have a client who, big tech executive, been working hard for a long time. He'd love to be the captain on a boat, so he may, do that when he retires. Retire and volunteer. There's lots of different things and different ways to approach retirement as well. So when you're working, earnings after 62 can still increase Social Security, but Social Security is really the highest 35 years of earnings. So if you were a stay-at-home mom, or for an example, so I, when I started my business 21 years ago, I went from, I'd worked, let's say, for 7 or 8 years, making good money, and then I did not take a paycheck for quite a few years because I was building a business. So I was putting all the money back into the business. So those 5 years or so, when I didn't take a paycheck, if I work longer, then it'll help me. But otherwise, usually working longer doesn't help the Social Security benefit quite as much. Although you get, the longer you wait to take it, as long as you live long enough, the more that you'll get out of it. Okay, so if you take Social Security early and work, your benefits could be reduced. Okay, so in 2021, I don't know the numbers for 2022 yet, but $1 benefits is withheld for every $2 earned. Okay, so they'll get added back in eventually, but you're not getting your full Social Security amount, and then some of it could be taxable as well. Okay, so You still pay Social Security tax when you work in retirement and even when you're receiving benefits and working. Okay, so again, the benefit only really increases if it adds to that 35 years worth of income they take into consideration. So there's also a cliff with Medicare. So George and Martha have Medicare's Part B and D, so regular doctor and drug plan. Their modified adjusted gross income in 2019 was $275,500. And they just sold some stock for $1,000 gain. Okay, so they owe $188 in tax. So the regular tax rate, plus there's a Medicare, if you make over a certain amount of money, you have to pay an extra 3.8%. Okay, so 15% capital gains plus your 3.8%. But what happens is they also went over the cliff. So Medicare takes a look at this every year. And what happened is that because they went from the third bracket here down to the fourth, their monthly Part B is going to go up about $180 a month, and Part D is going to go up $39 a month. Okay, so just for selling that $1,000 worth of stock, they both are going to have to pay almost $2,604 in extra money. Okay, so it probably would have been better not to sell the stock, do it in a year that might make more sense. But just important to know about these things and what's going on. So they stole stock, here's a sale. And again, this is the real tax because they're paying more to the government for those benefits because they fell into the next bracket. So Jim and Ann, this is also some things with Medicare. So Jim and Ann are 68 years old. Jim retired at 65 and Ann retired at 66. Ann's employer had health insurance for retirees, so they waited to really enroll in Medicare Part B. You really want to enroll in Medicare pretty much right as you retire. And so what happened is that the missed enrollment period penalty, because they waited, is going to be $356 every year. Plus, there's going to be some increases. So that those 2 years of not paying could really be like a $10,000 mistake. Okay, so, and then you start taking out the minimum distributions 72. So you just have to be careful of the coverage and things like that. Okay, so are there other tax traps? Well, we just want to also see how you use taxable, tax deferred, and tax-free to manage your income and tax brackets. Now, historically, and this is a portfolio that Sam and Mary have, and they need $8,500 a month. Okay, so they have IRAs, regular IRAs that they'll pay regular income tax on. They have Roth IRAs that they won't pay tax on, and they have a joint bank account that they'll pay capital gains on. So every one of these things is a little bit different. Now, normally, what we all learn as financial advisors, and when you actually do a financial plan and spend down this way, it usually is the best. So first you spend your taxable money, okay? So bank accounts, investment accounts that are non-retirement, spend tax deferred money, okay? So that's IRAs, 401ks, etc. Then tax exempt, which would be your Roth IRAs. And normally that enables the money to last longer. However, there's a lot of different things that we can do, especially now that we have the Roths. So it could make sense to convert to a Roth. It could make sense maybe if you have a low income year before you need to take required minimum distributions, that you take distributions a little bit earlier. So we need to take a look at all of these things. And this doesn't make sense for everyone, but for some folks, we have some clients that this does make sense for. So spend taxable money first, convert regular IRAs to Roths in low tax years, and then spend tax deferred money until depletion. Okay, and then spend your tax exempt money. Okay, so everyone's going to be a little bit different. Sometimes it's really tricky to get these low income years where you can convert the Roth, because if you convert a traditional IRA to a Roth, you're going to pay tax on whatever you converted. Okay, so it's a little bit tricky, but definitely can be a really good strategy. So IRA, again, a taxable amount. So Jill converts $100,000 from her IRA to the Roth IRA, and she's going to have to add $100,000 to her income. Okay. Now, what may make sense is when you're looking at these things, you can roll over just a portion. You can roll over 20 grand or 30 grand. But if you're in the middle of a bracket and it's not really going to raise your taxable income that much. Or, let's say that you're in that 22% bracket and you have 30 grand more to go, you could roll 30,000 over, and then that would still be at that 22% rate. And then you can kind of do that year in, year out. Okay, so just a different way to look at it. There's also some examples where if a business owner has low sales, they may want to convert. Business owner with high expenses, they have a lot of deductions. Non-recurring medical bills, if you have those in one year where you would get a lot of deductions, it could make sense. And this is the best time really is usually after retirement, before getting Social Security benefits, pensions, and IRA distributions. That's really the best time to convert from traditional to Roth IRAs. So we want to see, are you trying to keep income below a threshold so you're not going to go over it, or are you trying to fill up a threshold? So just important to kind of take a look at. Also, approaches to managing tax brackets. So if you had a year where you had a lot of money coming in and you needed money to live off because you're retired, it might make sense to take tax-free money from life insurance policies. So you can borrow money without really having to pay it back, and you don't pay tax on that money. You could also sell highly appreciated stock for low or no capital gains. Okay. Take distributions from IRAs or 401ks to take advantage of this lower rate. Okay. So depending on your tax rate, capital gains go from 0 to 20% on appreciated stock. There's some other strategies that are a little bit unique. So using a health savings account strategically, or qualified business income deductions after funding a company pension. So these are a little bit of different situations. So another way to do it, another way to kind of lower your taxes are to use charitable gift and tax planning. So Albert and Shirley are in the 24% tax bracket. They give $5,000 to charity. They just write a check out and send it to their charity. They have $15,000 of existing itemized deductions, and in 2021, the standard deduction is $27,800. So they still have a big gap. There's like a $12,000 gap in there. So they're not going to get a tax benefit from giving the $5,000 because they haven't hit the standard deduction yet. So basically, each year, a person can give up $100,000 to a qualified charity. Okay, so it counts as a requirement of distribution, but it's not reported as income. There's no deduction on income tax. So the biggest difference is that you're taking the $5,000, you're not writing a check, it's going directly from your IRA into the charity. Okay, so we have several clients who have named charities as the beneficiary of an IRA. They may actually carve out a portion of it and then send the RMDs, to that one so that the other beneficiaries can have the other IRA piece, but there's lots of different creative ways to do this. So basically, a charity gets $5,000. Okay, so if you don't send it directly to the charity, it's reported as taxable income, and you can see that you're going to get the $1,200 extra hit, so it's going to cost you $6,200. Whereas if you actually send it directly to the charity, you'll see the requirement distribution is satisfied. That's excluded from taxable income. So you're saving that $1,200. So that total cost of charitable contribution is really, $3,800 or so. Okay, so just a different way to look at it. So also, when, as we move through retirement, we're gonna, if we have money left over, we want to see how can we most easily transfer it to other people in the family. So we want to make sure estate planning is still really important. Okay, so this is Phil and Mary. So this is a little bit of a gruesome example, but one nonetheless. So the rule treats a beneficiary as if they had purchased the inherited asset the day it was left to them. Okay, so there's something called a step up in basis. So let's say if my mother passes away, on that date, we would get a step up in that basis. So if she bought Apple stock for, $100 and now it's worth, $1,000, we don't have to pay tax on that $900 gain. Okay, so however, if you own it jointly, you only get half. Okay, half of we would only get, if I own 50 shares and my mom owned 50 shares and we had a joint account, only 50 shares would get the step up in basis. Okay, so my 50 I'd still have to pay tax on. So Phil and Mary hold taxable investments in a joint brokerage account, joint tenants' rights to survivorship. They have the 120,000 investments have a long-term capital gain, and Phil is diagnosed with terminal illness. Okay, now if they kept it as it is, Phil dies and Mary inherits Phil's half of the joint account, the step-up basis eliminates the long-term capital gains on Phil's $60,000. Okay, so if she sold everything, she just owed tax on her gains. So, and of course, once someone passes away, whatever investments you have going forward, you had to pay tax on that. Okay. So another way to do it is Phil gets diagnosed and then they move all the money into his name, and that avoids you paying the tax on that $60,000. Mary won't have to pay tax on the 60. So she will have a step up in all of it, when he passes away. Okay, so just saving money, just a different way to save money. So this is inheriting IRAs. So Pam is 65 years old. Her son Kyle is 40, and she leaves her IRA to Kyle. Okay, $400,000 IRA, 6% rate of return. Okay, it used to be, and some clients have beneficiary IRAs. My husband has one where his mother passed away, and he can actually take distributions over his lifetime. Okay, so a couple of years ago, with some of the COVID legislation, they stopped that. So now you have 10 years. So anyone going forward, you have 10 years to take all the requirement of distributions. Okay, so since Kyle's a sole beneficiary, what I would recommend is that he takes a distribution every year so that it doesn't add up. At the tax bracket doesn't totally add up. So his $54,347 versus if he waited until the 10th year and he has to take it out at that point, it would be $716,000. So he's saving tens of thousands of dollars in taxes by taking it over time. And maybe he take tax out and he could just, reinvest it or whatever he wanted to do with that money. But you'll be at a much lower bracket if you take the money in pieces over time. Now, taxes and long-term care. So again, this is a little bit of a tricky area, but premiums could be deductible. Payments from policies for reimbursement of long-term care expenses are tax-free. And we wanted to see how you can pay for long-term care costs can have a big impact on the heir. So let's take a look at an example. So Florence is a widow. She qualifies for long-term care benefits. She gets in-home care benefits, $60,000 a year, and she has $20,000 a year in Social Security income. She has $400,000 in an IRA. She has life insurance with a long-term care rider. Okay, and this is a really great way to do long-term care insurance. So this long-term care rider, $500,000 to kids when she passes away, or she can take $10,000 a month for her long-term care costs until the money's depleted. So the last 5 years, she really didn't pay any income tax at all. Okay, she has high deductibles for unreimbursed medical expenses. Then she takes her long-term care insurance, pays $300,000 for that in-home care. Okay, so the kids get life insurance of $200,000. That's left, the $500,000 minus the $300,000. They get $200,000, and they get $400,000 of IRA funds. Okay, so it's one way to do it. Another way that we don't think about, because the long-term care insurance is for long-term care, another way to do it is that she uses the IRA money to pay for the long-term care expenses. Okay, so she takes the money out, she pays tax on it. Okay, the kids then inherit tax-free life insurance of $500,000 and $100,000 of the remaining IRA funds. Okay, so in this example, they end up with $300,000 of tax-free money versus $300,000 of taxable money. Okay, so just some little tweaks that you can do, and that's going to save, probably $60,000 for the kids. So there's a lot that goes on with these different areas. So I think breaking it into the 4 spots is really good. So, know what your after-tax savings before retiring. You really want to do a retirement plan illustration. You can go online. There's lots of great resources. we can help you out, or your financial advisor can help you out. Fund Roth accounts, they're really great because you don't pay tax on the way out. Early retirement, really looking at Social Security and then Medicare taxation. Let's see, can we fill some of this in and maybe do some Roth Roth conversions early in retirement. We don't want to make sure we're not hitting any of those areas where we're really going to owe a lot more in taxes, or if we do, we want to know about it. Then middle retirement, manage and your plan, your requirement of distributions, you're going to have to pay tax on those. So let's take a look at that and how that's going to work out. And then late retirement, and even throughout retirement, you want to organize your assets so that it is efficient for estate planning purposes. So as you can see, your tax exposure and the things that you're going to be doing are going to be changing over these 4 phases of retirement. So just really taking a look and help you anticipate how you may want to take money and how you want to plan on doing that. Okay, we want to make sure you have the lowest tax rate possible. So this distribution phase can be pretty complicated when you're saving money, just kind of putting it away. It is what it is. There's not as much room for error. There's definitely different things that happen as far as income and deductions and stuff. But we want to make sure we're managing taxes throughout retirement. This is going to be critical because, you know, mistakes can hurt you long term much more dramatically during the distribution phase than they can when you're accumulating money. Okay, so just keep on going. Okay, anybody have any questions? And I want to thank you very much for being a part of this webinar and listening. So if there's anything we can help you out with, please feel free to give us a call, send an email, and we'd be happy to answer questions and help in any way we can. Okay, thank you so much.